I'm so pleased to welcome to Forward Guidance for a fireside chat Angus Shillington, Deputy Portfolio Manager for the Emerging Markets Equity Strategy at Van Eck. Angus, welcome to Forward Guidance.
Thanks, Jack. It's a real pleasure to be here. Thanks for asking me.
It's my pleasure. Angus, how would you describe emerging markets and how it differs from investing in developed markets or DM? What is something that if someone's been a veteran of investing in developed markets for one or even more than one decade, they might not know about emerging markets EM?
It's a fantastic question. I would think about it through the framework of expectations, right? In the original sort of 1.0 EM, there was a period where EM did well up until the global financial crisis. The expectation was fast development, great demographics, awesome companies emerging, and this crushing inefficiency, right? So the returns from emerging countries haven't been met. I think the basis is the same. These are deeply inefficient countries with young populations. They have the potential for company formation and exceptional stock market performance.
So they are higher growth economies than developed markets because their economies are so much smaller in terms of GDP. How does that track on to the performance of the stock market? One might think, Angus, that the higher growth economy is, the better performing the stock market is. And sometimes that plays out. However, you look at China and they have had an incredible Chinese growth miracle. Their economy has been growing at 8%, 9%, 10%, double digits, yet their stock market, particularly as of late, really has struggled and has not matched anywhere close to how amazing the economic performance is in terms of GDP. So could you speak to that? How do you make sure that stock investors, equity market investors are being rewarded when the economy they're investing in grows so much?
The expectation is always that a fast growth economy, these sort of eye-popping GDP numbers of sort of 6, 7, 8% will pay off in share prices and stock market returns. Now, that's turned out not to be the case in many instances. So there is a reevaluation that has gone on, right? There are fabulous companies like TSMC in Taiwan that have delivered on expectations, but there are a lot of cases, China's a good example, where corporate governance hasn't lived up to expectations, where demand on capital or where maybe subsidies have taken away from returns to investors.
And Angus, let's take China in particular. How is it that government involvement can hinder corporate profit growth or allocation of those profits? You mentioned subsidies, and to me, subsidies can be beneficial for a particular company, such as if the market rate's at 6% and the government allows me to borrow at 0% or 2%, or they give me some sort of credit, that sounds like it would boost profits, not hinder them. So can you get specific about what in China is stopping the corporate profit growth from following the GDP higher?
I mean, to that question specifically, I think you've kind of got to separate it into sort of domestic market, export market. Domestic market, I think a good analog to follow, which leads you to sort of the key point of risk, which is regulation, right? Is what is permitted and what is not permitted, right? So, the post Deng Xiaoping, to be rich or to get rich is glorious, deregulation kind of process that was triggered that led to Tencent, Alibaba, all these sort of really fabulous private businesses were then badly disrupted when the rules changed, right? So the regulation needs to be somewhat predictable to allow you to commit equity capital and protect risk. And then the other side of the business model, which I would argue is a more dominant business model, is the export piece, right? And I would sort of think export 1.0 is, when I guess the US call it Walmart outsourced production of the sort of cheaper, lower value added stuff to China, right? So they got into the habit of producing competitively priced goods, mostly some services. Now, when the world got more competitive or the playing field somewhat changed in terms of maybe there were tariffs or maybe currency values changed, China tended towards putting their thumb on the scale in terms of favoring their domestic exporters by offering cheap subsidies to build scale by a handful of different things that help them to do it all a lot cheaper. So optimizing to really what the Chinese business model has been for many years, but specifically over the last 5 to 7 years, and they've been very open about it, is they would like a larger market share in global consumption, right? And that's effectively anything from what they've been doing in the past of the sort of lower end, sort of call it clothing and sort of cheaper plastic toys kind of stuff, to moving much more up value into EV batteries, EVs, motors themselves. So there is a sort of cause and effect of taking on this sort of proposition. We're going to grow market share, and that means you need to be more competitive. Now, quite often the companies themselves are not more competitive in and of themselves, but the environment of how much it costs to borrow money or how much it costs to buy land to build plant machinery is the differentiating factor. So it's a little more complicated, but fairly clearly into those two categories.
And the Chinese stock market has suffered over the past 2 to 3 years. I'm looking at a valuation of one particular index, and it has the price to earnings ratio at 13.5, which appears cheap. How are you perceiving the risks and reward in the Chinese equity market right now?
This has become a really big topic of conversation, and I have some quite strong views, and I'll try and keep them sort of compressed. And that is, academically, it is not true to make the statement a low price earnings to ratio is a good investment, right? It is just not the case. A price earnings to ratio, price to earnings ratio really tells you the story about the risk of a particular asset or index, and that, broadly speaking, gets into the categories of growth quality, company quality, regulatory predictability, and I would argue that multiple with the current outlook for China is probably fair, right? It's sort of where it has been coming into the sort of glory days in the mid-teens, and it's sort of gone back to that level where things are a little more difficult to predict, and therefore risk is priced at a lower level. So yes, the PE is low relative to other markets, but that would imply that the risk is higher, and I think that's probably a pretty fair approach.
So you think the risks are fair? What are the risks as you perceive them in China now? Is it that the economy slows and there's a recession in China, that perhaps it already is in a recession? Is it that it's moving from an investment-driven model to a consumption-driven model will fail? I've interviewed several academics who are very well respected who have made exactly that point. Or is it regulatory?
I don't think you even need to get too complicated about it. I think, again, different companies, different sectors, different risks. If I think of sort of my role to represent as a fiduciary, I want to know 3 years, if possible, out that, first of all, my equity is safe, right? It's the riskiest part of the capital structure. And secondly, I want to know that the cash flows that I am modeling, there's a high probability that they will be delivered. Now, I think what's going on in China, or has been and is right now, is difficult to assess. And therefore, it's difficult to draw conclusions, in the sort of 3 to 5 year out category. The one I would maybe center on, just as a really good example, would be, the IPO market. Now, the regulators have decided to, put a halt to IPOs. Now, the objective, or what they're optimizing to, is to stabilize share prices of currently listed public equities. So, the idea is to, if you reduce supply, right, and maintain demand, or demand may grow, then you can keep prices in equilibrium. Now, the problem is that pushes up the value chain, and you've got a venture capital guy who's up in wherever, Hainan, who is thinking of committing capital to a new innovative tech business, and he's going, well, hold on, if I can't exit through an IPO, why am I committing capital right now? So there are cause and effects of these sort of relatively short-term decisions to try and balance out asset prices, which have really very long-term implications on, investment dynamics and relative competitiveness. So I think the simple answer to your question is because it's really difficult to know what the future holds.
And what do you make of the Chinese real estate market? Prices have been falling consistently and sharply month over month. Do you think there was a real estate bubble in China? Do you think it's popping right now? And I guess there's a lot of uncertainty, but how are you seeing the various scenarios play out?
Real estate in China has been used not dissimilar to real estate in the United States or Europe as a store of value for households, right? So it needs to be protected, right, as a balance sheet item because you lose control of that. Things go sideways in your macro outlook. In China, it probably got ahead of itself. Money was relatively cheap, and the tax mechanics made it easier to buy and hold real estate with relatively low cost. But there was very little else to invest in China. Right? There were stocks, which is kind of a casino, or real estate, which has typically gone one way. Was it a bubble? Difficult to say. Is it going to completely collapse? That's probably the good news. I think the authorities sort of stepped in and made some adjustments. And I think they've saved it from collapsing. And if you look at it through the analog of, as I say, most major economies, household balance sheets tip towards their real estate investment. I think the Chinese government have managed to prevent that situation from really deteriorating. So, in many respects, you can look at that as good news.
So that's China. When you scan the emerging market universe, what countries or country are you the most bullish on, where you see just a lot of potential?
I'm a sort of practical, logical, kind of academic principles guy. So I don't try not to think sort of bullish, bearish. I try to think about the risk proposition, right? Where can I commit capital? Where can I have an edge? Where can I find mispriced securities? And to me, or to us right now, India is that place where there's an awful lot of sort of push and pull in terms of understanding of returns and risk. And there is a lot of positive going on right now that is just generally misunderstood and mispriced.
Like what?
The very simple answer is that India is basically going through a transformational reform period, very similar to what we saw in the United States during and post Ronald Reagan. Now that lasted a long time. So we're talking tax reform and income reform and various other structural issues that really reduce productivity. Increase productivity, reduce cost. And at the same time, India's digitizing like at a breakneck speed. And digitization means that this policy can be rolled out and sort of supercharged. So those two things are happening on top of the pretty well-known demographic story. Now, I mean, there's no real surprise to the sort of performance piece. You just need to bring up a chart on whatever service you subscribe to, and you'll see that India's been one of the best performing markets over the past 25 years, beating the S&P in US dollar terms. The problem is, how to have the conversation with people about what happens next, and aligning that with all the other sort of understandings and risks that are going on right now.
So when you say transformational economy and digitization, what does that mean? People are using smartphones more. They're ordering stuff online. And what are the tailwinds of that to the economy and profits in the stock market?
Well, I mean, let's split them out. So most good policy is compounding, right? So you do one, then you build on top, then you build on top, you build on top. So if you think about the way that has worked now, Modi turned up in 2016. One of the first things he did was a digital ID program, which had sort of started before he arrived, but he did it. Digital ID means that everybody can be KYC'd, right? On a thumbprint or a retina scan. Super interesting starting point. At the same time, Reliance Industries was laying down a 3G, 4G network with an ambition that they could deliver data through a smartphone, a cheap smartphone at scale, so call that mass adoption, at under $1 a month, which is insanity. So as they were laying that out, the government policy was being laid out. So we went from having very few smartphones to call it 800, 700 million smartphones today, right? So that's call that 7 or 8 years. At the same time as we went from digital ID to this was a cash economy, and the policy was open a bank account. Everyone must open a bank account. You get a little inducement to do it, a little bit of money. You walk in or you do it online, KYC yourself with your new ID. They then demonetized the economy, meaning that all the cash that was floating around out there, including a lot of illegal cash that had been taken by corrupt politicians, had to make it into the bank. Now, you put it into the bank in your new bank account. The corrupt politicians couldn't. They had to burn it. So you were at this sort of period, you were cleaning up a lot of the corruption and efficiency. You were pushing cash into the formal economy. Now, what that ended up doing was increased and improved tax efficiency, right? So where there was a cash economy and you had a cash earning business, you sort of had an option to pay tax, right? You could do it if you wanted to, you didn't. So in reality, nobody paid tax. So once everything was digitized and everything was, you could capture it at this sort of IRS type level, tax compliance went through the roof. Through the roof means it was started to double year on year from around 21, 22, meaning that suddenly you'd gone from a country that really had real difficulty investing in development and improvement to a country that was well funded, where the tax revenue was growing at twice GDP, meaning the wallet that could then be taken to build soft, hard infrastructure and digitize this economy was readily available. So it's sort of this combination. And I think when you sort of loop back to what I said about the performance, you look at the chart of the Indian index, you can pick whichever index you want, you convert it to US dollars, you stack it up against the S&P, and you think, how is that even possible? Well, India had been growing at 7% GDP average for the last 20, 25 years. It's got a bunch of exceptionally good businesses that pay absolute cash returns to shareholders. But then you scratch your head and go, how is that even possible that it beat the S&P over 25 years? Didn't have any QE, crazy like cash policy. And it had none of the sort of NVIDIA / AI tech hardware names. And the answer is because this is a market that, one, the economy grows fairly predictably, and two, the businesses compound growth over long periods of time. And over time, that has resulted in the returns you've seen. I think the bit that's sort of interesting is to try and have or begin the realization with investors that that was the past, right? That was the returns that this index delivered when the economy was relatively inefficient. We're now introducing significant efficiency, right? And introducing addressable markets that have much higher margins and similar entrepreneurs and a young population. Potentially that return structure is higher in the future. And I think that all of this together is what gets me to a place where this is where I want to go looking for investments.
And so you have a history of predictable earnings growth and high quality businesses in India that you describe. If you had to attribute that to another, and compare it to, you say, so it's, if you had to attribute that to something, what would it be? You say, okay, so these businesses, they're kind of like businesses in America in that they, when they can actually grow their earnings, unlike China, which has had a more difficult issue. Is it cultural? Is it political? Is it that entrepreneurship is celebrated instead of punished? Is it the nature of the industries that they just tend to have higher margins, unlike other industries? So how would you explain that predictability as well as repetition of the high profit growth?
It's sort of a bit of all of the above, but I think there's one very specific piece that became a cultural imperative, and that sort of resulted in where we are now, and that is the banking system was a horror show. I mean, a horror show, meaning that if you were an entrepreneur, right, or a business owner, even if your business was awesome, right, and generating good returns, and your business plan looked great to the bank manager, there was a good chance he wouldn't lend you any cash because he just didn't have the balance sheet to lend. Mostly state-owned banks, and that has changed over time. But what's happened is that this business culture has developed where debt is the devil, right? You do not want to take on debt because if you got it, it was expensive, and there's a chance you wouldn't get it, but it was unpredictable. So you needed to generate returns on invested capital or returns on equity, or look at it as very simple cash flow. You needed to be able to generate considerable cash flow if you wanted to invest and grow your business and build, a dominant market share and moat. So over time, that really has hardened, right, as a business culture, and businesses in India, and I'm not saying all of them, but I'm saying the vast majority of them deliver globally competitive returns to shareholders year in, year out. Now, the interesting part is now you lay that on top of the opportunity set that is growing and accelerating, and a GDP that probably comes in at 6 to 7% for quite a while. And that's sort of where I get very, very excited.
So that's an interesting point about the banking system, that Indian companies had to compete for credit, so they learned to grow and learned to generate earnings growth with a lower percentage of credit. I know in the United States, a lot of companies in the S&P 500, the bigger companies, their debt is in the bond market, high yield bond market, investment grade bond market. I also understand that in China and Europe, it is different. It is mostly bank dominated. In India, what do you see there? If a company does have debt, are they issuing bonds? Are they borrowing from banks? And what significance, if any, do you think that has?
They prefer no debt. I mean, it's really that simple. I mean, some companies do, and you tend to find that they're the ones that are more likely to get into trouble. At the end of the day, the business culture and the business imperative is that I do not want in my income statement a line that says interest payment. And if you're competing against somebody who doesn't have an interest payment line, it's probably much more difficult to be competitive on price. And at the end of the day, product pricing, super sharp product pricing, is really what gives category leadership in most commerce in India. So it's really about how you build your capital structure, and how you maintain long-term cash flows and create long-term investment outlooks that you want to be able to predict what your margins are, and predicting what your margins are allows you to predict pretty clearly what your cash flows are. And if you can predict your cash flows, you can build out plant infrastructure, whatever capacity you need to meet demand. And that's how you basically grow your company. So very long term, but it's enabled by a couple of things, one of which is the demographics, and the other of which is this very predictable long-term GDP growth that is being, as I said, sort of supercharged by policy and digitization right now.
So in America, some very mature companies, the Magnificent Seven, like Apple or Microsoft, they generate so many earnings, they don't really even need to raise capital. They kind of are self-funding. But your typical company that I think of, it needs capital, and it either funds itself in equity or in debt. So you're saying a lot of companies in India are not financing themselves in debt, or there's a lower percentage of debt in the corporate sector. How are they financing themselves? Do they not need capital, or do they need capital and they go to the equity markets? Tell us.
No, it's just pure cash flow. So, a business that generates, and these are often super prosaic business, sort of call it industrials, guys who make pipe or adhesives. So they get a 13, 14 gross margin that turns into an operating margin on a very lean business of 10, maybe 11%, which generates cash flow, which is gives them roughly 10 to sort of 15% excess to skim per year. And they slowly built out plant capacity. They buy a piece of land 1 year, and that land will last them for 10 years. They add machinery and plant, and so in 10 years' time, they've doubled their capacity and they've doubled their output. But they put no risk and no threat to their ability to generate gross margins, or to take on debt, or to take on too much capacity that's going to bring margins down. It's just extreme financial discipline.
Extreme financial discipline. It's interesting. So tell us. You referenced earlier the demographics. Why do you perceive the demographics of India to be favorable? And then can you also tell us about urbanization of people moving from the country into the city, something that has happened in China over the past 20 years and is typically associated with high economic growth?
Okay, let me think about how to approach that fairly simply. I mean, the first one I think to understand is there are no set sort of variables to why a younger age group will pay you a great return, what the demographic dividend is. It works for India right now specifically, because with the median age of in the low 30s, with all this sort of digitization and disruption, you tend to find that younger people have much more capacity to adopt. They're early adopters digitally. They're early adopters of business formation in technology specifically. And they're sort of driving not only the mass adoption, but they're driving the sort of company formation and the business model growth and the basic coding that's required to bring in the efficiencies that India, needs. So a good example of that, the tax infrastructure was reformed, right? What used to happen in India before Mr. Modi came in was each city, each zip code, each state could do whatever taxes they want. Now, a lot of this was sort of corruption related, but I would check into a hotel in Mumbai and I'd stay a night and I'd have a can of Coke. And when I checked out, I'd get 28 pages of bill, right? Which was, 1 page of my Coke in my room and 27 pages of taxes, right? So taxes were reduced to one single line, right, across federally, across the sort of, federally cross borders. So this created a kind of European moment where an Indian business that was terrified to go out a certain zip code because they just knew they'd get overtaxed or destroyed. So they've become super lean and very good at doing business in that zip code, suddenly realized that they could, cross zip codes, they could cross borders, they could become continentally scaled. Now, this kind of energy and ambition and growth trajectory, leans very well into a younger population. So all of these things, very specific at a given time, are driving the pace of growth in India. So that's on one side. The urbanization thing is a sort of natural development sort of track. But I think what's super interesting about it is, so people will be less farmers because you've got agricultural machinery, and they'll want more for themselves, their kids. They'll move to the city, all that sort of stuff. It's fairly obvious, but this is happening at the same time as you've got these huge infrastructure projects rolling out. So think about it like in comes the tax revenue that I talked about. They decide they'll earmark X million dollars for an urban light rail system in Pune, right? So they'll build this urban light rail system which wasn't there before, right? And that urban light rail will go from the center to way in the outskirts, call it 15 miles away, right? And it'll have 10 stops along the way. What that will do is they'll create 10 opportunities to build relatively small towns, neighborhoods around those stations, because now, instead of needing to live right in the center of Pune to get a job, you can live 15 miles away. So what you create is this sort of scale opportunity to allow people to come to cities and move at relatively low prices, because you're building the infrastructure that's allowing suburbs to build. And then as you build suburbs, you build the opportunity to build shopping malls and real estate developments and gyms. And so this whole thing sort of scales out really incredibly well off of this sort of flywheel, which is just effectively, reform, digitization, raise revenues, invest heavily in infrastructure, digital and hard, and the thing just spins. And I think this is the really sort of super exciting longer term trajectory, of which demographics is part, but it's not the sort of part that people sort of classically think of, just lots of people, lots of middle class families. It's more than that. It's bigger, and it's much more dynamic.
You think it's more about technological adoption than it is the fact that the average 25-year-old is going to be working, the average 75-year-old is probably not going to be working, and the average 25-year-old is going to be spending a higher percentage of their income than a 75-year-old?
I mean, that is, the idea of having a sort of right way up economy, right? The pyramid is correct. More people paying taxes than people drawing, benefits from the economy. Is a sort of given. So yes, that is there, but the opportunity set, now there are some difficulties, there is some friction employing the vast number of new entrants to the labor market, and that's causing some strife. But on the whole, right, the bottom end of the pyramid is younger, more dynamic, more open to change. And I think that drives both the sort of economic piece, which is digitization, company formation, disruption, and then on the other side, it drives tax increases and the ability to to create wallet to invest continuously in hard and soft infrastructure.
What are the types of companies or types of industries that have really shown the most remarkable profit growth as well as shareholder returns in India? If I think of America, it's branded companies, it's technological companies, a company like Apple, a company like Monster Beverage, a company like Costco, although that's slightly different. What are the types of companies that, in India not only have performed what the average Indian market has done, but have really dominated and led the way higher?
I think you sort of, there are different ways to split this and segment this, but I would sort of think about it broadly as, let's think about this as a development phase, right? So we're going through this period of transformation, right? Though I think phase one I would think about as the enablers, right? So who has enabled this transformation? Now, Reliance Industries and their geo phone network, right? So they built out, a 3, 4, now 5G phone network, created a price structure that enabled mass adoption. Bharti Airtel, very similar, built out, they were sort of there before, but the two of them sort of co-own mobile phone. So if you co-own mobile phone, then you also co-own this sort of digital relationship between customers, and you can sort of cross-sell them media, some retail. So those guys have done exceptionally well, as I would call sort of the enablement layer. And then you call, the enabled layer, right, is where I think we're looking for some really interesting forward looking returns. Now that's a lot of that is sort of industrial infrastructure driven. So let's say that's a given. People understand that. You want to be, I think, looking into digitally enabled logistics platforms, right? So where before, it took you 3 times longer to get a tomato to market, therefore it was a 60% chance it would perish. You now have fully scaled, digitally enabled logistics businesses that can efficiently crush the cost of logistics and also reduce dramatically the wastage. So it's business like that, and then that moves upstream to, you think, hold on a second, if the cost of food or the inflation of food is coming down or staying static, then household incomes are going up. Now, if household incomes are going up and inflation is coming down, you probably have long-term rates coming down, so real estate becomes an interesting option as a household investment theme. So it really, there's no one particular. You've created this sort of digitally enabled, countrywide, very young population. You've crushed inefficiency with policy, and then now let rip to take advantage of this in really very many areas. So it's difficult to nail it down specifically. We tend to think it's company by company by company, but they have to have the return structures, they have to have the transparency, and we have to believe the regulatory structure is at least benign going forward.
And one thing I noticed is India has had a higher inflation rate than the US over the past 10 years, let's say. It may be different in 2022. India had less inflation, I believe, than the US. But the Chinese economy has not had that much inflation. Is there something about the Indian economy that is structurally inflationary about, maybe inflation is not 2%, but it's 4% or something higher. It's not out of control, but when you have inflation, nominal growth tends to be high too. So what is your perspective just on Indian inflation, as well as, an Indian economy with an inflation of 4% is better than a Chinese economy, perhaps with a deflation or inflation of 0 or 1%?
A little inflation is always good, right? So it helps a lot of sort of lines in an income statement, but too much of it problematic, as we sort of discovered in the US recently. So most Indian inflation was around inefficiency, the inability to get onions to market, or the inability to drive better returns from agriculture. So if you had a bad harvest of whatever, then you have an inflation event. So the baseline is about trying to reduce costs across the board. So when you sort of think about, okay, we digitize, right? So let's say we bring, the cost of logistics down by, hundreds of basis points. Now that's going to feed into inflation. At the same time, you make distribution more efficient of, state payments or naturally you bring down inflation in clips all across the economy. So a more efficient economy is less prone to inflation. So less prone to inflation means you tend to get a normalized level. I think the central bank is looking for sort of 3 or 4%. At 3 or 4%, they'll be able to reduce rates structurally and bring not just a structurally lower term structure to rates, but also relatively lower volatility to inflation, which means the cost of capital will also come down over time. So it's a function, like a lot of the other stuff we talked about, of an economy going from super inefficient cash to very inefficient, very efficient, sort of digitized, mechanical, well invested, well funded.
And is India an importer, a net importer, or a net exporter? Can you compare its model to China, which is an export powerhouse, has a trade surplus with the rest of the world, and the US, which is a massive importer and has a trade deficit with the rest of the world? And what, if any, significance does that have for Indian businesses?
It's relatively self-sufficient. I mean, India's always been a net importer of energy, so oil and coal. They will always, I mean, coal will roll off over time. Oil, India's quite far down the road in terms of developing green hydrogen. And so I'd argue that sort of moves on, but they're sort of accidentally exporting. And I say that because some companies have found that they just produce globally competitive products at very, very, very competitive prices. So quality and price. India will always be, has been, always be a net exporter of I think, human capital. So, those emphasis TCS is really just about exporting services. Now you've got 175 million people that speak English and are ready to be exported digitally to the global economy. So I guess that will be an export. But on the whole, you should sort of think of India as having relatively low sort of global impulses. And that really sort of feeds into the whole kind of country risk proposition as a foreign investor.
I just looked up the price to earnings ratio, the valuation of the Indian stock market. I got 27 or 26.99. I'm sure it depends on what index you use, how you measure it, next 12 months, previous 12 months. But that's interesting because the Chinese basket that I referenced earlier has a PE ratio of 13.54. So almost exactly, India superficially has a price to earnings ratio double that of China. So that might lead one to say China is cheap and India is expensive. Do you agree with that, and why?
Here we go. We're doing this. I got to tell you, so let me sort of back this up a little because this is super interesting. So we started to sort of ramp up communication with our sort of investing partners maybe 12 months ago. This narrative of India being more expensive is a big deal. People think it, people believe it. I think it's absolute craziness. I think it's nonsense, and I think you can logic it away in 5 minutes. But the reality was that I thought I could sort of step in, or we could step in and explain away that expensive narrative is wrong. Couldn't be more wrong, right? This narrative is so embedded, right, and is so believed that I think it's time to sort of think about how we change tack on that. So let me explain that very simply, and then we can sort of dig in or debate or logic that. So there are a couple of things that differentiate India from China, right? Because I think the reality of this sort of expensive is a subjective construct, right? Let's just think about it that way. So in order to be expensive, you've got to be expensive versus something else, right? So, and I think you sort of hit the nail on the head, is that the people will always point to the fact that India is expensive versus China, right? And to sort of deconstruct that, the first point is sort of complicated and annoying, but India has a March year end, right? So when you compare, I'm not sure what you looked up just now, you compare, 2026 earnings or PE of India with 2026 earnings or PE of China, it's not an apples for apples comparison, because India's 2026 ends in March, so actually it's mostly 2025. When you do the math around that gives you about a 300 or 400 basis point of differential, right? Then the other big differential between the two is that India grows, one, at higher quality, and two, more predictably, and three, quicker than China at an EPS level. So that makes up for another sort of 3 to 5. So if you normalize for one, the unusual year end, and two, the quality and growth differential, the multiples aren't really that out of whack. So it sort of gets you to ask the question of why has this sort of become so embedded over time? And you can think it's a sinister thing, or you can think it's an ignorance thing. I'm not sure. I don't know where to go, but I think you've got to argue, right? Either one, China's going to go back to its glory days, right? So the relative valuation of China is lower, but it's going to go up, or the relative valuation of India is higher, and then it's going to go down, right? And maybe I can just sort of put numbers around that in a second, but to me, this analogy is like lining up, 5 automobiles, right? 4 of those automobiles are terrible. 1 of those automobiles is great. Instead of having a winner, you have a loser, and the loser is the one that is highest price. Now, of course, that's going to be the automobile that's the highest quality, and it's a very similar situation in India. Now, the way that I kind of think about it is, I think you're quoting a sort of off cycle, right? So calendar year end rather than a March year end. So let's say we normalize that. So I sort of think about 24 months out is roughly the best time. So on a rolling 24-month out basis, I kind of have India between 20, 21 times earnings. I think that's sort of about right. The United States is on about 20. And to be honest, all of the sort of relatively high quality markets, whether it's Taiwan, US, France, Germany, UK, Switzerland, all around that level, right? So let's put that to one side. India will grow corporate earnings at sort of mid-teens, right? So call that 14, 15% earnings growth over the next 7 years. You can also stress test that by saying, what is GDP? GDP is going to be around 6 to 7%. And then what have Indian companies paid you in excess return over the last 20 years? And the answer to that question is around 7% as well, which also gets you to a 14 number. So let's say you're growing at 14%. Now that's high quality, it's compounding. So compound 14 over 5 years, that gives you 90 to 100%, right? So that's just compound return of, call it 14% each year for the next 5 years. So 14% compound is roughly 100%. Divide that by 5. So actually you've got a CAGR of 20%. So 20% a year as a shareholder, and you're being asked to pay 20 times earnings for that. That doesn't seem wrong to me at all.
In terms of long-term investment results, return on equity and ability to grow earnings is the most important. So if you take a company like Costco, you bought it in 1995 versus a company, one of the worst performing stocks, Air France. If you bought it, let's say you bought Costco in 2000, you bought Air France in 2000, Costco would have performed way better. But if Costco was 3 times as expensive, so you're cutting your investment returns in 1/3, you still would have crushed Air France. And needless to say, if China enters a depression and their earnings contract, and maybe even companies are nationalized, and India continues to like the US, grow its profits very highly, then yes, the valuation differential will be more accounted for.
No, I'm not saying that at all. I'm saying half of that. I'm saying that India's returns are very predictable in a way that you said Costco's are very predictable. And the price of a steady return on capital, i.e., the ability to be able to compound returns, naturally that price is going to be higher. So think of anything that goes into the Berkshire Hathaway portfolio. China, I don't think you need a crisis situation. You just need a continuation of where you are now. Difficult to predict, right? And if you run the same kind of analysis as I talked about with excess returns of India over China at an index level, right? At an index level, Indian companies have returned a negative value over the last 25 years median, where Chinese companies have returned a negative value, just making sure I say this right. Indian companies have returned a positive value. So naturally, you're going to have to pay a higher price for the predictability and the consistency of return. China's growth is relatively lower. The multiple is relatively lower. The risk is relatively higher. And the sum of that statement is it's very difficult to say what your return is going to be. Now, if I go into the sort of India situation and say, I should get paid 14% on average, and I should be able to compound that over time, you're able to say at an index level, I should return in local currency, 2x in 5 years' time. Now, I'm not making that as a prediction. I'm just simply saying that's kind of how I am thinking about it. So if you can invest in businesses that are predictably compounding a certain number, you can be much more certain about what your outcomes will be over longer periods of time. And the benefit of Costco-like companies, right, is you think, wow, that's a crazy multiple for a 1 year growth number. So you say, Costco, I'm paying 20 times earnings and I'm only getting 13% growth. But if you get 13% growth every year for 10 years, that's 350% over 10 years. Divide that by 10, that's 35% a year. And a 20 times multiple, 35% sounds awesome. So this is really the sort of the grind between China and India is how far out can you predict, right? How sure are you that you will get paid as a shareholder for investing in the equity of a certain company? And I'm saying from an Indian perspective, if it's the right company, your predictability is very high. In China, it's a lot less high.
Right. I think buying Costco at 20 times earnings was a great investment decision because I think now it's 40 or 50 times earnings, which seems a little pricey for a grocery chain. But what do I know? Angus, when you are constructing portfolios that invest in India, what are you trying to do? Are you trying to pick the companies that will be the winners, and you're going for that like venture capital like return of one of them is just going to just compound enormously, or are you trying to just judiciously avoid the losers and let the outperformance go that way? I mean, I assume you're doing both, but can you just you're trying to do both? But can you tell just about that process and how it's different?
Yeah, I mean, you raise a really interesting point, which is, look, when you have the kind of disruption, right, that I'm laying out, right? So a great business in coal or a great business in that's made automobiles but had a license given them to by a cousin who happened to be a member of a government, right? These businesses are done, right? So there's going to be a lot of churn around at an index level. Some of it has happened already. So if you buy an ETF, you have the problem you have with ETFs generally, which is you're underwriting a slice of failure alongside a slice of success. So I think your question is a good one, which is how do you invest in India, right? And I think the broad framework is the same, right? Which is, and I always think it's about study past data, find businesses that can predictably generate returns over time. Now map that over the future in terms of this business, got a defensible moat, addressable market that's growing. You as a shareholder can compound those returns inside the capital structure or with dividends or whatever. That's, I think, sort of level one, and that's sort of a large cap approach. In the sort of mid and small cap space, we're much more about just global domination kind of thing, right? Global in the context of continental wide, right? Because you're finding businesses in the sort of mid-cap space that were constrained by tax, that were constrained by regulation, that have now had those shackles taken off. And it's, we have a truck finance business, right, that is materially better than every other truck finance business in India. And it didn't have a chance to compete because one dominated over here and one dominated over here. And now it's a level playing field. And these guys are just cleaning up, right? So you get much more sort of opportunity for big deltas in the sort of smaller cap. So the way I sort of think about investing is one, I want to be large cap compounding, liquid, reliable returns, relatively low beta, relatively low risk, balance that out with a slightly higher beta, slightly higher alpha. And you need to pay a little bit more attention to what's happening under the hood in terms of return. But again, if you have the right people running these businesses and the right people who have the experience of reinvesting their own capital, the risk is relatively low.
Angus, I know in India, a favorite destination of some investors has been the financial sector. Those shares on the whole have performed quite well. Could you describe why the financial sector in India has performed so well, and how it compares favorably perhaps to, for example, the financial sector in China, which has made a lot of bad loans, or the financial sector in America, which is quite regulated now, perhaps justifiably so?
That's a great question, Jack. So first of all, I think I mentioned earlier on that banking was a nightmare, right? And that changed somewhat, 10, 15 years ago, where some licenses were issued to private banks. Now, private banks in India were smart enough to say, I am not lending into this corporate sector there's a bankruptcy law. They're already encumbered with these other bank loans. It's a disaster. I'm going to be consumer only, right? So the banks that set up there, which were like HDFC Bank, was a good example. Yes Bank, Axis Bank, they set out to be consumer only. So think about them more like JP Morgan. So mortgages, credit cards, that kind of stuff, high margin, relatively low risk. So these businesses grew up very fast, very successful. Because the rest of the banking sector was busted, it was an incredible investment destination, opportunity, return structure for investors for quite a long period of time. Now, this is where the whole India story is so interesting, is things change, right? So when you assume, like I've laid out, that the economic story is just improving, it's getting more predictable, well, things turn a little south for these banks because we did the KYC digital ID program. Then, everybody was asked to open a bank account, and then all cash was sucked out of under beds through demonetization and put in bank accounts. Now, this created a point in time where the banks basically brought in tons and tons of cheap deposits, right? They turned around, they lent those cheap deposits out really quickly, which arrived maybe 2 or 3 years ago, and suddenly there are no deposits to raise because it's already in the bank, so it's organic only. We have all these high margin products already late. So suddenly loan growth had to come down because there were no deposits to fund loan growth. So as this sort of economy, banks have been a relatively a loser in this sort of growth phenomena because they grew very quickly. There was a sort of pig in the python type situation. So we've tended to pull back from that opportunity, and we're much more focused on very specific sectors of financial services. So I talked about truck financing as an interesting one. Digital consumer lending is a really interesting place to be. We have a couple of investments around there, but we've gone very, very niche. And I think when you sort of think about the pattern match of what's happening in India, right, versus what happened in the US during digitization, it's not dissimilar, right? These patterns have roll out in roughly the same way. That, where Internet 1.0 in the US just crushed distribution cost, right? That was really what it was. It's exactly the same thing is happening in India. So the ability to connect one-on-one with a financial transaction, make transfers, is creating this extraordinary opportunity. So we're very, very specific in how we commit capital in our active funds. In our ETFs, and I don't want to really go into this in too much detail, we've tried to create product that is more active in order to try and navigate around some of these sort of disruption issues and valuation issues. But financials are always going to be a great place to go because, broadly speaking, right, financials are consumer stocks. So in developing countries, there's always going to be a big correlation between those two.
Got it. So to sum up, you like India.
I love. We are finding extraordinary opportunities to invest in India, and to a large extent, right, this narrative of expensive is helpful. I think at some point it will become expensive, right? And I'm talking about sort of tulip mania type expensive. I'd rather be in than out when that happens. But 22 times forward PE multiple, right, on GAAP earnings for a sort of compounding return of 18 to 20% seems like absolutely the right price for me.
Angus, any other countries in emerging markets? We talked about China, we talked about India. Anything else that is drawing your focus on the positive side or on the negative side?
Taiwan has always been incredibly interesting, right? I don't think many people understand the story of Morris Cheng, who is one of my heroes of all times. Morris was MIT, Stanford. He worked for the longest time, I think, with Texas Instruments, engineer. and he left because he was passed over for promotion. And he went back to Taiwan a little bit upset. And actually, he was originally from China. Went to Taiwan, and he was asked by the government to start a company. And that company really was the sweet spot of what he believed in, that semiconductor design should be done by one person, and semiconductor fabrication should be done by somebody else. Now, he set up a semiconductor fabrication company called TSMC, and the rest is kind of history, right? So Taiwan's become this sort of vibrant hotbed of manufacture, right, for the rest of the world. Some design, but mostly manufacture. And it has become truly dominant in that space. Now, if it hadn't been for TSMC, there'd be no NVIDIA. If there hadn't been TSMC, AMD would not have spun out its foundries and become fabless. But really, TSMC set the stage for a complete step change in how semiconductors are designed, manufactured, and I'd say released this cohort of designers outside of Texas Instruments and Hewlett Packard and Intel that have changed the world. So yes, it's still an emerging market. It's a bit of a mystery to some people that it is, but yes, I'm always fascinated by what's going on in Taiwan.
And I know anytime people go on financial media, regardless of their expertise, they get asked about NVIDIA and semiconductors, which have performed quite well in the market. But you do have a background in semiconductors, so I feel justified in asking you your view on the semiconductor market, as well as where the gross margin is going to be coming from. NVIDIA has, by my lights, grow. It's the largest company to ever grow as fast as it's growing right now. People say it's just like Cisco. I've done the research. It's not. It's growing much faster than Cisco was in the mid to late 90s. But at some point you get priced in. If they're pricing in 60% earnings growth and they only do 40% earnings growth, 40% earnings growth is phenomenal, but it's not up to that expectation. So just your general thoughts on that market, NVIDIA, semiconductors, as well as if the gross margin of NVIDIA is sustainable, if the gross margin is going to be expanding to other companies such as TSMC or other companies that supply NVIDIA or the AI revolution.
First of all, congratulations. I absolutely walked into that one, didn't I? So look, I mean, this is sort of a bit off scope of an EM conversation, but I've covered TSMC as an analyst for many years. So I think my perspective is probably somewhat unique from that point of view. NVIDIA is a hands down one of the greatest companies ever. And I'm going to start at that point. But as you say, right, we're at a point of time where what's happened in the past year, and it really only has been a year, we'll call it 18 months, of this sort of binge AI mania, that it was just in the right place at the right time, right? So the solution through, the A100 or the GPUs that they were rolling out, no one could even come close, right? That's the first thing. The second point is that NVIDIA have this software, call it an operating system for the sake of argument, called CUDA. So if you already have some NVIDIA stuff going on, you can just keep plugging NVIDIA stuff going. The interoperability is incredible. So that was super helpful. So far and away the best. There's a platform approach where you can sort of build and scale quite quickly. But also what was there, right, and people sort of don't stop to think about this, is this cohort of heavily cashed up tech businesses, right, being Amazon, Microsoft, these guys who are effectively the customers. So what you have is this sort of feeding frenzy, right, where there's a sort of nuclear arms race going out, and you've got to stop, I think, and we've seen this in all parts of tech, especially in Asia, which has been very boom bust over the years, where sooner or later the rules of economics kind of kick in and margins begin to get competed away, right? So let's say we have this sort of crazy setup we've got right now, and then you start to think, how does that stuff get competed away? And my feeling is that the minute you ask the question, when is inevitable, being that these margins begin to get competed away, when is inevitable likely to become imminent? When you start asking yourself that question, you've got to step back. And I think we're sort of there right now. So maybe, I mean, if you want to drill down into any of that, I'm very happy to.
Yes, the gross margins of NVIDIA have been extraordinary, but it's only a handful of companies that I perceive that have also had very high profit margins. For example, TSM hasn't participated in a wildly high gross margin thing. Do you think there's going to be a stage of the cycle where, I guess, NVIDIA is not really the picks and shovels, it's more designing the picks and shovels. Do you think that where the actual producers of the picks and shovels, TSMC, Intel, which actually just had a very quite negative profit outlook, or SK Hynix, other semiconductors, the actual producers of the semiconductors rather than the designers, to reference Morris Chang's discovery, have a big growth cycle that is not only growing their revenues but expanding their gross margins?
Look, I mean, this is a really, a fascinating point. So in technology, right, Morris turns up and the reason why what he has done has been so, transformational is he took on the capex, right? He said, I'm going to build all the machines, right? And I'm going to get really, really good at making whatever chip you want me to make, right? And he's sort of like an awesome mother or father at Thanksgiving, right? Mysteriously manages to get everything on the table at the same time, cold beer, wine open, all that kind of stuff. The customer service is impeccable, and he'll do whatever you want him to do. But what he does most of all is he takes the cost of building equipment off of your balance sheet, right? And that's all on him. Now, TSMC has a right to a gross margin that is relatively high because underneath the gross margin comes all the cost of capex and depreciation. That's around, call that mid-50s%. NVIDIA, on the other hand, is taking a very high gross margin because, and it turns into quite a high operating margin because they have relatively low cost at the bottom. They just hand the plans to TSMC, they tape it out, make it, they sell it, charge a very high margin. This gets you into these sort of perfect storm situation. It just happened to be at that moment, nobody had a solution like NVIDIA had that solution. So over time, my feeling is like, again, the very, if you think about it through sort of academic principles, markets tend to segment, right? So the next cohort of customers may not be, right, as technologically demanding as the Amazons, the cloud service providers. Good chance they're countries with sovereign AI. Now they're not going to need the most expensive, leading edge Hopper GPU, right? So that may segment, but also vertically, the GPU functionality is likely to segment. Now this is a very expensive piece of equipment. Right now, people are being forced to run relatively easy, I'd say, but with respect, processes through those semiconductors. You could run most of your inference through very cheap ASICs chips rather than running them through an NVIDIA GPU. So that will segment out. And I think you're starting to see that these customers are saying, I don't want to get locked into this software platform. Google's developing Tensor, Apple's creating its solutions. That you start to see some fragmentation around what the end users are using because they don't want to get locked into one single provider. And then I think the last point, which is really starting to emerge, which potentially messes this up, is NVIDIA have promised, and I remember the call that Jensen got on, it was last quarter, maybe the quarter before, who he committed to this cadence of shipping new product, right? Not only have they got the best, they're going to replace it and improve it and innovate it so that every 6 months a new GPU is going to turn up. Now we're just getting news that the supply chain that's building this stuff, including TSMC, just can't keep up with the innovation that NVIDIA is asking it to do. So there's going to be stress around this. There's going to be fragmentation of customers. There's going to be a move away from being locked into possibly the software protocol, but also maybe the supply chain's not capable. At the same time, there are going to be other solutions. There's going to be ASICs, or it'll be Grok or Tensor, that mean relative prices come down. Because if you look at the TSMC numbers, the actual number of GPUs that's being rolled out, the increase is not that impressive because it's all being taken in the margin. So at some point that margin is going to come under pressure. And as I say, I think, when you're asking yourself the question of when is this inevitable, right, going to be imminent, I think that we're getting to that point right now, because the upgrade cycle, right, of an innovative company is usually backward looking, right? So if you look at how earnings progression have been for NVIDIA or any innovative company over decades, they report a beat, right? Then the analysts upgrade their earnings, then they report a beat at the next one, they upgrade. But everything is driven by what has happened rather than what is happening. And what analysts tend to do, because they don't really know, understand, or have the transparency, they tend to extrapolate the growth that's happened over the last several quarters way out. And I think the point that you made just now at the end is you can still get great returns from NVIDIA in terms of growth of EPS. You could be even 50% a year, but that still comes in a lot lower than what's forecast by many analysts. And if it comes in at below what's forecast, then the multiple that is ascribed is going to be lower too. So, back of the envelope, we were talking about it internally, the lowest sensible tech analyst 2 years out, EPS, take their EPS, put the same ratio on the PE, the price would be nearer 50 than 100. So you can still have great growth and great earnings, but there is potentially risk to the share price. So it gets you to that point that I've heard Jan van Eck talk about a lot recently. Great company, bad valuation. And I think that's sort of where I would end up on that one.
Great company, bad valuation. So you don't have the view on NVIDIA that you have on India, where it's a great country, the earnings growth is, and the valuation is more expensive, but it's justified and it might even be cheap. You don't necessarily think that about NVIDIA at this time.
Yes, it's a very different sort of investment proposition. So if you dig into the income statement of NVIDIA and you find out where the cash flows are going, right? They're not going to shareholders, right? They're just not right now. There's a very large amount of share-based compensation. So there's a bit of a sort of conversion shuffle going on in terms of GAAP earnings versus adjusted earnings, right? I can't remember the exact number, but it's billions of dollars of stock that's not being expensed, right? Then 40 or so % of cash flow is being invested in share buybacks. Now, you may say that's a good reason, or there's merit in that, or there's not merit in that. But at the end of the day, yes, that is being returned to shareholders, but it's being returned to shareholders at a valuation that a lot of people are questioning. So the ability to do simple sort of compounding math around some of that stuff just becomes much more difficult than a business that's returning you hard cash, clean cash, 14, 15% as a minority shareholder, has pricing power, has sustainable margins, and is facing a very predictably structural growth consumer buyer client. They're very different propositions. So there's naturally going to be a lot higher cyclicality in a sort of situation like NVIDIA, and that cyclicality presents itself in multiples, right?
Right. And if you look at trailing earnings, NVIDIA is quite expensive. The price earnings ratio of 75, which is more expensive than relatively expensive companies such as Costco, Chipotle, and Tesla. If you look at forward earnings, however, NVIDIA is actually cheaper than all of those companies. And the issue is, what if the forward estimates are too rosy? That is definitely possible, in which case the earnings are not going up as much as analysts expected, and then the valuation is going down because there's a disappointment. However, I'll note that last year people were saying, oh, well, Jack, you're quoting forward price to earnings ratios. Actually, the expectations were way too low. So NVIDIA was cheap based on that. So I just want to be clear that when you say NVIDIA is going to be challenged by gross margin going down from a super high level to a less super high level, is the competition that its own customers are going to start competing with them because Microsoft, Meta, Google, they're saying, NVIDIA, your chips are the best in the world, but we want to build our own system.
Yeah, just a simple law of economic supply and demand mean, you can't request and have met, right, a price demand that gives you those kind of margins. Super normal. And I think and this conversation is very interesting. And I tend to think about it through the lens of, I am paid to look after other people's money, right? In the same respect that to some extent I'm paid to look after my family's money, right? And I don't want to take a risk that seems too high to me and be at the point where I have to explain to my wife that could have gone either way, but I didn't take any profit off the table. So it's, as I said, I think it is somewhat inevitable that margins come down. Difficult to say when, right? And if it's further out, then maybe the share price has a lot further to run. But I think, as I say, when you're asking the question, is that inevitable, imminent, you've got to be thinking about reducing exposure or diversifying exposure.
Diversifying. Thank you. And Angus, I heard recently, and admittedly it was from DC people, not semiconductor experts or financial people, but that ASML had a monopoly. Basically, they were the only company in the world that their lithography could create these level of high level chips. Is that true? And do you have a view on just if they have such a deep moat, how long that moat might last?
On ASML?
Yes.
Yeah, I mean, ASML are incredible, right? Their innovation chops and what they've delivered in terms of sort of EUV and machinery that can do more, better, faster, more efficient is a linchpin to this whole story. However, right, it has a lot of customers, right? So the corollary of the NVIDIA story, and to some extent the ASML story, is Intel, right? Intel didn't see fabless coming. Intel believed they could keep sort of designing the chips that they've always designed, throw them over the wall and somebody would buy them, right? That market disappeared, right? Or it started to dry up, and unless they were able to build and design competitively like a fabless plus TSMC, then they would end up in the problem they're in right now. And the problem they're in right now is that they're committed to building out plant and machinery. They're 14% of ASML's customers. So, you got to know what's going on under the hood, because for every sort of great customer from ASML, like a TSMC, there's also, an Intel hiding under there. And what Intel are doing now is horrifying, because, they're taking all this government money from, for subsidies of building out fabs and plant and equipment, and they're firing people at the same time. I mean, that's a terrible look politically, and something is obviously wrong. But my point being that, unless you understand the sort of the shifting tiles of most companies, you're not able to make the sort of predictions that people want to make, and it sort of loops you back to NVIDIA, which is that, as Japanese people say, trees do not grow to the sky, right? You've got to have a point where you say, hang on, enough's enough. I'll take the money and run.
Thank you, Angus. So going back to emerging markets, you don't like to speak in bullish and bearish, but in the language of countries you see the most favorable risk reward and the countries where you see the least favorable reward. Would I be correct in saying India, you say one of the, if not the greatest risk reward? And then what is the country where you see the least positive risk reward in the EM universe? Is it China?
Oh my God, that's it's a beast. I got to be really honest with you, right? I'm going to say that there are two categories of country. Maybe I'll sort of re-ask your question, which is, where can you take more risk and where can you take less risk, right? Because this is really where it comes down to, as a sort of active investor, is you're buying companies, right? And those companies have a big or a small risk key off of whatever the economy is doing, right? So, in India, that risk is relatively low, I think. In China, that risk is relatively high. Now, when I bounce around the other markets, Korea, Taiwan look great. So they're in the sort of, green light. You can sort of take more risk there. The less predictable are kind of all of the rest, where you've got to be very careful about companies you pick. You've got to be very selective about balance sheets. And I think this is sort of takes us back to where we started this conversation, which is India's kind of the opportunity that everybody thought they were getting when they started to invest in emerging markets 20, 30 years ago, right? But India has not been what they've gotten, right? They've gotten China and some bits of Brazil that haven't worked out the way that they'd expected, right? So now that the perfect opportunity is there, and actually has been there for a while, which is India, and it's being offered at a slightly higher price, back to the automobile analogy, People don't want it. So it's a difficult asset class. I mean, it's a real grind, because in order for multiples to be fair across the board, right, we need a weaker dollar, and we need the US not to be sucking in quite so much capital, right? So US equity is 75% of equity, so very heavily weighted. That probably comes down over time. So it's difficult to answer the question directly, because when things look more positive for the less good emerging markets, they will do better than the likes of India, which is a plodder, right? So super difficult, and that's sort of where the sort of portfolio construction piece is super important, to balance out risk-adjusted returns, to balance out sort of symmetric and its asymmetric risk. But most of the countries are not going in reverse, and I think that's the right way to put it. There is genuine improvement everywhere we look in EM. It's been up and down in Turkey. There's Russia was obviously an issue, but is no longer in the index. But most of them are going in the right direction to various degrees. And to that point, I'd say there's none that are an absolute disaster area, that are in the equity index, but there are a couple that stand out as radically better.
Well, Angus, thanks so much for joining us. You've given us a lot to think about on India, emerging markets, and semiconductors. Of course, Van Eck, the sponsor of Forward Guidance, is involved in these areas. And I know you, Angus, are involved in 2 ETFs, as well as a mutual fund. People can find you on Twitter at Angus Shillington, TO. People can find Van Eck on Twitter at VanEck_US. And the website is vaneck.com. Thanks again, Angus.
Thank you.